Greetings guys, I welcome you in this beautiful video. So I'm excited to bring this video to you. As some of you know that we've started our reading and we are reading this book. We are reading this book, so we are reading one chapter a day, and I'll be making a video on what I've learned, on what I've gathered. So in front of me I have notes that I was writing while I was reading this book, some few things that I've learned. So the first chapter of this book, it focuses on individual psychology. It focuses on how a trader should relate towards the market, on how a trader should think towards the market. So guys, the notes that I took here, it's like 3 pages, but I'm not gonna be sharing 3 pages with you. So this video is gonna be short. I'm just gonna be like binding related points together just to make this video a little bit short and smooth, so that you'll be able to enjoy it. So just keep in mind that there's a lot of notes that I get at, but for this video I'm just gonna summarize them and just bind them together so that it will be a short video. So let's get started with the first one, and which is something that I've been highlighting in most of my videos, is that firstly you have to be realistic towards the market. I know this is something that you hear a lot, but it's something that really differentiates between a winning trader and a losing trader. So it is actually the fork that separates between the actual harvest and the chaff that needs to be burnt. So if you are not realistic, if your expectations are not realistic, I'm just gonna tell you it's gonna be hard. It's gonna be hard. So whatever that you do in the market, just know, keep it in mind that you cannot control what the market does, but you can always control yourself. You can always change the way you behave towards the market, but the market will be forever behaving in its own way. Meaning, even if you have a good trading system, just keep it in mind that you can never know the direction of the market, and you can never predict the market 100% of the time. So be realistic in that way, and also your expectations, guys. This is so important. What you expect, or the returns that you are expecting from the market, they should be realistic as well, because the moment you feel yourself with notions or with expectations which are beyond, that's where you create a mindset that will force you to be a losing trader, because you'll create a mindset of a gambler. You'll create a mindset of a gambler, because that is also covered in this chapter. You shouldn't create, or you shouldn't push yourself in a corner where you will find yourself gambling, or when you will find yourself hoping for luck, or maybe trading based on your desires or what you want the market to give you. So know that the market is going to behave in its own way. So what you have to do, you have to just bring yourself, or do the best that you can to just do the right thing. Which also lead me to my next point, which is your goal should be to trade well. Your goal should be to trade well, not to make money. So this is a very important point, guys. You should focus into trading well. So what is trading well? Trading well means following your trading system correctly, not breaking any rules. Trading well means having good risk management in place. Trading well means eliminating emotions, which may also include fear and greed. That's trading well. So you should focus into that thing. Say, focus on following your rules, focus on eliminating emotions, focus on managing your risk properly. That's trading well. So this is your primary goal, or this should be your primary goal. If it's not your primary goal, you should focus into trading well, doing the right things. And then one also important thing that I received from this first chapter, it is something that we overlook. As a trader, you should have a diary, not just a diary to just write what you're doing today, or what you're feeling whatsoever, but a diary where you will record your trades, a diary where you will record both the reason why you took the trade and both the reason why you exited that trade, if you exited it manually. So what is the significance of this diary? So this diary is gonna help you to develop in the future. Let's say you are trading and you are losing. if you are losing, you have to like shift and try to see why you are losing and try to adjust from there. So you will not be able to know your flows if you don't have a track record of your losses or a track record of your trade. So if you have a track record of your trade, the time you close the trade, the time you open the trade, the reason you opened and you close the trade, if you don't have that somewhere in a paper or in a document or whatever you will choose to record it, if you don't have that, it will be hard for you to develop. It will be hard for you to change. It will be hard for you to improve because you do not know your flow. So firstly, you have to know what is causing you to lose money, and you'll know that by tracking your trading, recording whatever you do, whatever trade you take, the time you enter the trade and the time you exit the trade. And the writer also highlighted an important thing, but it's a bit hard, but it's easy if you have a computer, by recording also the chart, like taking a screenshot or saving the chart when you enter the trade, and also saving the chart when you close the trade, so that in the future when you go through that diary or that journal, you'll be able to see how was the chart when you actually took or made that decision. So I hope that is making sense. No? So one other important thing is that you should avoid shifting blames. You should avoid shifting blames. For an example, a lot of traders will say, I lost because I didn't have enough capital. Usually a lot of traders cry with that if I had enough capital, that trade wouldn't have blown my account. Because sometimes you open a trade, you open a buying position, you go long, and the market just goes down, and all of a sudden it reverses and go to your direction. So a lot of traders will say, if I had enough capital, the market was not gonna blow my account. You see, that is not a good reason to make, because even if you can fund with a double amount, you will again repeat the same mistake. So you are not undercapitalized, but you are actually over trading your account. So always keep that in mind, that if you usually have an excuse of saying, my account is so small, my capital is so small, no, you are not undercapitalized, but the problem is that you are over trading. It's either you are using a big lot size, or you are opening multiple positions which are so heavy for your account to carry. So I hope we are learning from that. So make sure, guys, that you don't fool yourself. You don't lie to yourself. Don't lie to yourself. If things are not going well, admit that things are not going well, and that's the best way to change. Admit that things are not going well. Don't deny. Don't deny the fact that you are losing. If you are losing, just admit that, okay, I am a loser and I have messed up. And by admitting that, that's the first step towards growing. That's the first step towards fixing things. So then you can then work your way into fixing those things. So firstly, it is don't deny the fact that you are losing. And again, try to fix things. And the way you fix things, it is usually by taking one step at a time. Take one step at a time. There is this quote that he indicated on the book. He also made an example about alcoholics, the way they recover, the systems that are used there. So there is this thing that they do, which is living one day at a time, meaning they focus on to doing the right thing today. They focus on to doing the correct thing only today. So that's what you should do as well when you try to improve, or when you try to recover from being a losing trader to being a consistently profitable trader. Try to do things step by step. Take one step at a time. You usually hear people saying a journey of 1,000 miles begin with one step. So that's what I can say is, well, take one step at a time. And one thing that you also have to know, just to wrap this video up, you have to know that trading is a minus sum game. It is a minus sum game, meaning when you lose, you'll always be losing more. Let's say we just approach it in a neutral way. You will always be losing more than you make. Why? Because there are things like commission, there are things like spread. So if you decide to say, I'm gonna risk 10 pips and I'm gonna make my reward to be 10 pips. If you lose that trade, you might lose more than you can make on that 10 pips. For an example, let's say if you win, you will win $20. And if it happens that you lose, that same number of pips is likely to take maybe $25 from an account because of spread, commissions, and all the other things. So make sure that for you to survive this, you always have a reward which is greater than the risk. Now, you always have a reward which is greater than the risk. And the market is designed that a lot of traders lose money. So you don't just need to be average, but you need to be step ahead. You really need to be head and shoulders above the crowd for you to make it through this. So that's it, guys, for the first video. I hope this was helpful. So let us continue to read. You're gonna proceed to the next chapter, and I'm also gonna post a video about what I've learned from there. So thank you guys for watching.